If you have no idea what a stock market is and how it works, this episode is for you. Hello everyone, I am Vijay Mohan and you are watching Investment Insights. Imagine that you can make an amazing Madras filter coffee at home with your own secret ingredients. Everyone who gets to taste your coffee just falls in love with its taste. You realize that your coffee is so good that you can sell it through a coffee shop. You run some quick calculations to see whether it can be a profitable business. You start with the expenses. Rent has to be paid for the location. Salaries need to be paid for the employees. Inventories like coffee, milk, and whatever your secret ingredients, they all need to be purchased. Equipments like coffee machines, grinders, and refrigerators need to be purchased as well. And of course, there will be other expenses like utilities. So you realize that you need close to $100,000 per year to run your coffee shop. Lucky you already have the money saved. So you choose a busy corner location in an intersection and open a nice coffee shop. You are calling it Madras Filter Coffee. Your coffee shop turns out to be a huge success. Everybody loves it. You are seeing that the crowd is growing bigger day by day. By the end of the first year, you have a total sales of $125,000. That means you have sold coffee for a total of $125,000. This is called revenue. So your revenue for the year is $125,000. Your total expenses to run the coffee shop is, as you expected, $100,000. You have sold coffee for $125,000 and your expense is $100,000. Then your profit is $25,000. Nice. Now that your Madras Filter Coffee is famous, you are thinking of opening new branches. You know that you need at least $100,000 to open a new coffee shop, but you have just $25,000 profit in your hand. So you have two options. Wait for 4 years till you make a total profit of $100,000 and then open a new shop. Or you can ask other investors to invest in your coffee shop right now. You choose the second option and go to your friends. 10 of your friends are interested in your business and they are willing to invest $50,000 each. So you have $500,000 in hand. You can open 5 other Madras Filter coffee shops. So there will be a total of 6 Madras Filter coffee shops. Now let's take a look at the partnership details. Your money $100,000 is already invested. New investors have provided another $500,000. So a total of $600,000 is invested. If we say one share is worth $50,000, then we have a total of $600,000 divided by $50,000, 12 shares. You get to keep 2 shares as your investment is $100,000. Each of your friends get to keep 1 share each as they have invested $50,000 each. By the end of the second year, this is how the financials will look like. The total number of coffee shops, 6. Total revenue, 6 times $125,000, $750,000. Total expenses, 6 times $100,000, $600,000. Profit, $750,000 minus $600,000, $150,000. This profit will be shared across all 12 shares. In reality, you get to charge an additional fee for managing the whole business. But here in our story, let's assume that you are the nicest person and you are sharing the whole profits with your investors without any management fee. So earning per share is the total profit $150,000 divided by 12, $12,500 per share. Because you own 2 shares, you get $25,000 and the rest of the investors get $12,500 each. This is how a business is run and profits are shared across shareholders. What if one of the shareholders is not interested in the business anymore? Then they can sell their share to any other interested buyer. The buyer decides how much each share is worth and how much they are willing to pay. And of course, the seller decides who to sell to. Obviously, they will choose a buyer who is willing to pay the most for the share. This is exactly how a share market works, just that it will be on a larger scale. Let's take Starbucks for example. 1.15 billion shares outstanding compared to 12 shares in our example. By the end of March 16, each share price was $100.43. When we have 12 shares in our example, it is not that easy to find a buyer if we want to sell our share. Not here in the share market. As there are more than 1 billion shares outstanding, there will be a huge crowd buying and selling the shares every second when the share market is open. We can see that more than 8 million shares were traded on March 16. And so the price of the share changes every second depending on the demand. How do we know whether Starbucks as a company is doing well or not? By looking at their financials. They release their financials every quarter, that is, every 3 months. You're looking at the income statement of Starbucks for the last 5 quarters. Yeah, there are a lot of confusing rows here. Ignore them for now. What you need to focus on is just 3 specific rows. Total revenue. This is similar to the total sales we saw in our example. How much coffee they have sold. Then total expenses. How much total money they have spent to run the business. And net income. This would be the total profit or loss for the quarter. All numbers are in thousands here. So Starbucks has a profit of $855 million in their latest quarter. For the whole year, they have a profit of $3.32 billion. This $3.32 billion profit is shared among 1.15 billion shareholders. So the profit per share of Starbucks is 2.88. This is called EPS, earning per share. Does the price of a stock always go up? No way. Price is dependent on the demand for the stock. The demand will be high when its business is doing good and bringing in more profits every quarter. But if the business is not doing good, or if the buyer see any risk to its business, then the demand will be less. Less demand will lead to a lower price. Risks can come in many forms. A new competition can show up in the market, or people could be locked up in their homes because of a pandemic. So there will always be risks for every business. So when should you buy a stock? You can buy only if you understand their business and also their risks in the market. You also should know if you are paying the right price for the stock. No one should be buying a stock because someone recommended in TikTok or you thought it is cool. But what if you do not have enough knowledge to understand a business or to measure its risks? Then you should be looking into mutual funds or ETFs that invest in stocks. We will take a closer look at them in the next episode. Thank you for watching.